Hey everyone, we've locked in our second quarter commercial real estate metrics, and for this video, I'm going to focus on what's happening in the apartment market. Now I have to say, there were a couple of surprises in the results. The economy and the apartment sector was facing a variety of headwinds in the second quarter. We had the conflict in the Middle East, inflation was rising as the price of the pump surged, and overall, consumer sentiment was hovering near a record low. So I was a bit surprised when I saw apartment demand surge in the second quarter. I mean, demand was weak in the third quarter last year, and it went negative in the fourth quarter. And the first quarter absorption was about on par with the 10-year average. So when you consider all the headwinds in the second quarter, apartment demand clearly exceeded expectations. But there was one thing suggesting apartment demand would strengthen, and that was job creation. Between June of last year and February this year, the US lost 62,000 jobs. That's at least part of why absorption was weak in the second half of last year. But since March, job creation has strengthened. In the last 4 months, the US has added nearly 550,000 jobs. And that was likely the catalyst supporting household formation and apartment demand. So in the second quarter, apartment demand strengthened, filling more than 194,000 apartments. And that pushed the national average vacancy rate down by 60 basis points to 4.5%. The demand was strongest in high development, high growth markets like Dallas, Houston, New York, Atlanta, and Denver. Looking at absorption as a percentage of inventory on a year-over-year basis, the top markets included Phoenix, Charlotte, Austin, Nashville, and Columbus. But while the high development markets filled the most units, they still have a ways to go to burn off their supply overhang. As a result, Sunbelt markets are still grappling with negative effective rent growth. Meanwhile, markets outside the Sunbelt delivered stronger rent gains. Top rent growth markets on a year-over-year basis include San Francisco, San Jose, Milwaukee, Cleveland, and Chicago. Oakland came in 6th, so the Bay Area dominated the rent growth rankings. From a macro perspective, the good news for apartment investors is that new construction is continuing to taper. Multifamily starts are down by about 75% from their peak in 2022, and completions in the second quarter were about half the level delivered in the third quarter of 2024. With the pace of completions expected to taper further in the second half of the year, if job creation continues, then fundamentals could strengthen even more. However, if the Middle East conflict is sustained or escalates, and if tariffs on imported goods are substantively increased, that could dampen the job creation outlook and put upward pressure on inflation. That could ultimately weigh on household formation and multifamily demand. And those forces could also influence the multifamily investment climate. If, however, inflation continues to taper as it did in June, then the risk of Federal Reserve rate increases could be diminished. But the Middle East conflict and potential tariff increases may push inflation higher, then interest rates would naturally follow. And that in turn could widen the buyer-seller bid-ask spread, driving additional market recalibration. In general, multifamily transaction activity has been on the rise since 2023, with transaction count up by about 51% compared to the cycle trough. A significant driver of that has been the repricing of assets over that span, with current average cap rates standing at 6.2%, about 150 basis points higher than they were in 2022. That said, we've experienced some upward pressure on lending rates as the 10-year Treasury now stands about 70 basis points higher than it was at the end of February. And that interest rate rise has created a bit of a headwind for multifamily investors. Nonetheless, the majority of these challenges are likely short-term in nature. At the end of the day, positive demographics and the high cost of homeownership will continue to fuel apartment demand. And at the same time, new supply risk should continue to diminish. That will drive long-term multifamily performance gains, and that's the opportunity for investors who keep their eyes on the horizon.